Welcome back to the course Introduction to Commercial Banking and Fintech. In this particular course, in the last class, we talked about balance sheet and we also looked at one of the case study, assumed case study in the case of SBI, and we tried to drive nuances from the balance sheet indicators, and we were able to see that how we got this sense of the overall outlook of the SBI and how SBI was doing with profitability and risk weighted assets, and also on the asset and liability side. We are now going to look at from the monetary policy transmission side, and we will be trying to understand some of the, so these topics we covered in the last session. So, let us move on to a new topic which is related to. So, we will have one or two examples on. First thing is the repo hike pass through to bank non-interest income or net interest income that the bank is going to have. So, if I am going to calculate this, how we can find it out. So, for example, net interest income, that if I have to calculate, how we can get it. We are saying that suppose RBI repo rate changes affect banks through asset and liability repricing. Asset in the sense that they have to reprice the loan, and deposit that they have to also go for repricing of deposit. It means the rate of interest on this, R on this, and R on this will also change. Floating rate loans reprice faster than deposits, creating short run net interest income effect. Now, suppose we have been given this data that there is a bank A which has the interest earning assets of 100 lakh rupees, so 1 lakh rupees. Loan share is 70%, of which 80% is floating, right? And this is all linked to two benchmarks that here we have, external benchmark and also the internal one, lending. So, you can say prime lending rate. RBI repo hike is 25 basis points, right? Deposit cost pass through that, so 25 basis point hike that the bank is going to have. So, they will have the, so pass on deposit cost pass through is just 40% of this, right? Interest bearing deposit is 80,000 rupees if this is the income. Baseline quarterly net interest income is coming out to be 3,200. Given this data, how can we calculate incremental asset side interest income? First, incremental liability side interest expense, second, and change in the net interest income. So, this is what we are going to see. So, 25 basis point hike, which means what it is in terms of quarter wise, quarter 1. So, it will be around 0.000625. So, this is what we get. On the asset side, we are having floating loan is suppose 70% of the total. So, loan share is the, and 80% is the floating, right. So, 0.7 and 80% that here we have, it is the floating. Total amount is 1 lakh. So, it is coming out to be 56,000. So, how much is the change in income because of this? So, we are saying that 56,000 into this particular rate that we are having, the interest that we are seeing, the percentage change quarter wise, it is coming out to be rupees 35. Liability side 40% they are going to pass through to the deposit. So, it is coming out to be 32,000. 32,000 again with the rate of interest change. So, this we are putting as rupees 20. So, net interest income, how much we are seeing? So, 35 minus 20. So, 15 rupees we are seeing, right. So, new net interest income. So, 3,200 already they have. Because of this interest change, if this is the criteria, that because 80% of this is on floating, these two conditions we must note in this case, and there is pass through of 40% on deposits, just 40% only. Maybe bank can say that if the deposit amount is this much, then only you can, otherwise you cannot. So, this is the case here. So, if these two are the conditions, then bank is going to see a marginal increase in the net interest income, and this is what we often find in most of the cases, right. So, what is the case? That deposit is incurring a less burden floating loans are adding to the net interest income, and these two are important factors to look at, right. We are going to also see one more case, that incremental CRR reduces interest earning assets while earning 0%, causing no net interest income drag, right. So this is what we have. Suppose NDTL base is rupees 1,50,000. RBI raises the CRR by 50 basis points, so 0.50%. CRR earning is 0% and short term alternative yield is 6% per annum. Compute quarterly interest loan. So how much so NDTL of this is 1,50,000. 50% is 0.005. So it is coming out to be 750. So if you are thinking about how much you have foregone your quarterly interest, so this is going to be 750. How much is the short term alternative yield? Is the 6% of this, and here we are going by the quarter wise. So this is what it looks like. So 750 into 1.5, you have 11.25%. What is that? So 750 crore, or so 750 rupees that here we have becomes non-earning, resulting in the quarterly net interest income loss of 11.25 crore, if I have to think about in crores, right. And you can think about that if they are not going for rebalancing or doing things, then it is helping the banks for the monetary transmission. Let me give a quick relook at this particular question, that in incremental CRR, so this is what here we have the cash reserve ratio, right. Reduces interest earning assets, right, because what is the learning here? Learning here is that we know that here we have a statutory liquidity ratio, and then here we have the cash reserve ratio. So what is the case? That some amount of money must go to the cash. So suppose today RBI is keeping at 5%. Tomorrow RBI increases up to 7%. Then 2% banks which they could have lent to the individuals on the asset side, they have to keep that as a cash reserve. So RBI raises the CRR by 50 basis point, here you can see. So here it is all about, you can say, a statutory requirement. This particular problem is not about the repo rate, it is about the statutory requirement. If the statutory requirement is not changed, then how much is the net interest income increase or decrease of the bank? So this is what about. So CRR is a liquidity tool, we know, right. So incremental CRR will reduce the interest bearing asset, because then you could have lent to the people, right, and while earning 0%, causing an on CRR this deposit, bank will not get anything. So bank get 0%. When RBI is going to increase 5 to 7%, whatever extra income that you have to keep as a cash will not be paid anything. On a statutory liquidity they get. So NDTL is 1,50,000. Cash reserve ratio increases by 50 basis points, right. CRR earn is almost, they don't earn 0%. Short term alternative yield that they have is 6%. Given this, if you have the CRR increasing, so you can see that 750 rupees they have to keep as a CRR now, and this 750 rupees, if they could have lent it, they could have added 11.25 in terms of crore or lakh, whatever you have to assume. So we can think that implicitly RBI, so repo rate, we know repo rate revision is an explicit attack, right. We know that whenever it is increasing, decreasing, there will be, so this is an explicit attack on the liquidity. Implicit attack could be in the form of changing the SLR and CRR, and even the bank rate, which is for long term borrowing, but anyway you can rule out these two. So you can see these two ratios are silent killer of the liquidity in the banking system. So this is what it is about. CRR hike and foregone interest channel, which means that if the RBI would not have increased by 50 basis point, banks would have lent this 750 and would have earned 11.25 crore, and because of this CRR hike they are getting, and there is no rate of interest on that. Rate of interest is 0%. So I have tried with this example to give you the understanding that it is not just the repo rate. Sometimes what RBI does is that they will be keeping the repo rate same, changing this CRR and SLR. In that, if the CRR is being changed, it is good for the central bank, they don't have to worry about, and it is loss for the bank, because bank will not get anything on the cash extra that they have to keep because of the increased CRR. So when you read the monetary policy change, or when you are seeing the stand of the monetary policy that monetary central bank is not going to change the rate of interest, then you have to look carefully that has there been any change with the SLR or CRR. If there has been any change in the CRR or SLR, then it means that central bank is silently killing out the liquidity in the system. They don't want to attack directly. They are attacking the liquidity indirectly. They are sucking the liquidity, extra liquidity in the system through the cash reserve ratio. So this is what it implies here. Let's come back to what we were discussing. I think 4 to 5 lessons back. So we were talking about interest rate effect. So monetary policy channels, we discussed this. Marshall-Lerner conditions and all we discussed. Tobin-Q theory, we discussed replacement cost of capital. So market value, firm value upon the, you can say, replacement cost of capital. Wealth effect we did. The bank lending channel also we did. Now we are getting into balance sheet channel, cash flow channel and price channel. Liquidity also we have done. So we will be touching upon this angle, and this particular chart I have already explained, so let's not get into it. So here you have, first is the cash flow channel. What is the transmission logic? That when rate of interest comes down, firm's cash flow go up. Then here we have adverse selections will be lower because firms will be having enough cash. They will not be, moral hazard will also be lower. Lending will increase. As a result, your investment will increase and aggregate demand will increase. What is the crux here? Crux is in terms of cash flow. What is how it is linked with the low rate of interest. This link is creating some kind of confidence or symmetry in the market. As a result, we have less of adverse selection as well as moral hazard, because banks will be finding it easier to borrow money and repay back the loans. So cash flow, it is what in receipt minus operating cash expense minus the interest paid. So this is what there here we have, and then here we have the short term and the variable rate. This is what we often find. So this is what here we have. Higher cash flow implies better liquidity, better capex, better everything, and it also leads to what we have, the higher interest coverage, which means that the repaying ability of the bank or the firm goes up. So this is what here we have. Easier screening, which is linked with the adverse selection, right? Higher interest coverage, which is linked with the moral hazard, that if they have higher interest coverage, then bank will pay easily, otherwise they will not be able to pay. As a result, it will also create some kind of negative impact, which means that after borrowing, after the contract, if they are investing in somewhere in terms of risky assets and also, it will be again impacting the moral hazard case, right? So this is what we often get. Now here we have the variable rate, cash flow and covenants. For example, suppose you have been given this, that a firm finances operations using short-term variable bank debt. When lending rates change due to monetary policy adjustment, interest expenses, covenant, compliance and borrowing capacity can change accordingly. If you have been given this data that initial debt of the firm is suppose rupees 500 crore, lending rate before cut is 10%, lending rate after cut is 7%, so interest rate has come down. Pre-interest and pre-tax EBIT, earning before interest and taxes, it is 90 crore, and corporate tax rate, it is 25%. It is proportional tax, tau we are using, right? Now here we are using the term covenants, right? So let's understand what is covenants and all. So here you have three things that you have to note. First thing is that debt capacity. What is the debt capacity? So maximum level of financial leverage as a firm can sustain. without undermining solvency, liquidity or external credit standing, which means that if the bank has AAA rating, it will mean so, which means that how much is the cushion for the bank to borrow. If the earning is suppose 300 crore, if they can borrow 3 times of the net income, so 900 crore, or suppose 600 crore 2 times. So this is what it implies. It reflects the combination of internal cash flow, generating ability, how is the firm doing, asset structure, tangible collateral, intangible, any patents, any kind of practice, goodwill that they have, business cyclicality or the industry risk, what kind of adverse situation that the firm is experiencing, tolerance of the lenders, investors and rating agencies, that how easier it is for the all these 3 agencies to take into consideration any kind of abrupt changes in the behavior of the firm. So how long they can tolerate. So this is about debt capacity is evaluated using the EBITDA based leverage. Interest coverage ratio is one indicator. Suppose EBITDA is 400 crore and a particular firm operates in a sector which a benchmark of 300 times of X, right, which means that the firm can borrow up to 1200 crore. This is what is the debt capacity, how much you can borrow given overall functioning, overall performance and overall tolerance level. So this varies with the sector to sector. So banks will have this particular understanding about that sector, that what is the likelihood of making money in that sector. So sometimes they will be revising 1x, 2x, 3x, sometimes they might be giving 5x, right. So that is the scenario here in this case. Debt covenants are contractual provisions in loan agreement and bond indentures that constrain a borrower actions to protect creditors' interests, right. So which means that how it is about the evaluation, you can say. So what is the trust, you can also think about the trust. So it deals with the agency problems. So this is what here we have. Now what are the types of covenants? So here it is the financial covenants here we have, which is talking about the leverage and the coverage cost. So net debt, EBITDA, interest coverage and all. Operational covenants, so it is about the restrictions on the asset sales, merger acquisition, additional secured debt. So this is what it is having. Informational covenant, so this is about the financial reporting, audit requirements and disclosure. So 3 important things are important. Financial covenants, which is related with the balance sheet. Operational, merger acquisition and all. So sometimes banks will not allow to go for merger acquisition if you have not paid the debt. If you are highly leveraged, then you will not be allowed. In case of developing countries or even the first world, because of the political connections and all, lot of leverage, highly leveraged firm, they go for merger acquisition aggressive. So which means that this is all about regarding expansion and how is the business riskiness that you want to consider. So it is linked with that. Informational covenants, which is regarding how much you are disclosing, and so regarding disclosures, how is the quality of your disclosure. So it is talking about that. So a representative covenants package may require 3.5x and here we have the 2x. So interest coverage is this and net debt upon EBITDA is 3.5x. So this is what is the normal industry structure that we have. So 3.5 times of this and interest coverage of 2 times of what you have the interest coverage, right. So this is what, if the interest coverage ratio for you is like interest coverage greater than 2 times, for example, if the industry standard is 7%, then your interest coverage must be more than 3% or so. This is what it implies. Net debt, which is like upon EBITDA, which is the leverage kind of indicator, it must be less than 3.5 300 times of your whatever is the net income all. So this is what, so it means that it is highly leveraged. You should not have that much debt accrued, otherwise it will create problem. So covenants leads with that. Another is the headroom. Headroom is just the how much is the borrowing. So debt capacity we have done. So headroom basically it indicates a lower probability of technical default and greater operational, which means that net debt upon EBITDA, which means that covenant, if it is giving like this and a firm reports 2.8x, it means that 0.7 is the headroom for this particular firm, 3.5 minus 2.8. So 0.7 is the headroom, they can go up to 3.5. So this is what it implies. They can borrow up to 3.5 of this if they are interested. Headroom is also some kind of a tracking norm for the banks when they are lending to the firms, that how much has been the lendings. For example, in India we say that if your earning is 1 lakh rupees, then you cannot go for borrowing more than 50% of your income, because you require some amount of money to feed yourself. Bank will not give you 90,000 loan if you have 1 lakh rupees of income, right. So this is what, so your EMI should not go beyond 50,000, because rest of the 50,000 will be using for children's education, whatever responsibilities you have. They can decide lakhs of rupees of loans only on the 50,000, whatever is the cover that they can do. So 10 lakh, 15 lakh, 20 lakh, whatever they get within that 50,000. So this is like headroom. The moment you have utilized your headroom of 50,000, then bank will simply decline your any loan rate of any loan request you put. They will say that you have already gone to the maximum limit, and as per the government norm, we cannot, or RBI norm, we cannot lend people more than 50% of disposable income, because they have to also live and survive and walk and have the healthy food, then only they'll be able to paying back, right. But if you have like reduced your exposure, suppose you borrowed with 50,000 of your EMI, 10 lakh rupees, you repaid 5 lakh rupees, right. So 5 lakh rupees of headroom you have, you can ask the bank, and bank would be happy to give you 5 lakh rupees extra, because you have already paid 5 lakh rupees only you have the outstanding, and you borrowed initially 10 lakh, you have paid back 5 lakh rupees. So 5 lakh rupees standing, so then you can go for top up. The bank will give you the top up. That is the headroom for the household. So I hope this example has helped you understand, and if they are interested. Headroom is also and all. So this is what it implies. So cash flow and coverage, if you think about, so this is what here we have. So given this particular example that here we have, financial operations using short term variable, this is what initial debt they have. So here they have the coverage. So let me just jump on this particular topic. So interest expense is how much? So initial is the 10%. So 10% of 500 crore, so it is coming out to be rupees 50 crore. Investment is period 1 is how much? R1 into D0. So which means that now it has gone up, it has come down to 7%. So now it is just 35 crore, right. How much has been the cash flow improvement? So I0 minus I, so 50 minus 35, 15 crore rupees you have the improvement. Pre-tax cash flow gain, how much you have? 15. After tax, because it is 25%, so it is now 11.25, because 1 minus tau that we have assumed earlier, right. So this is what here. Interest coverage covenants if you want. So here we have a interest coverage ratio that you have. So EBIT upon the initial interest, so it is 90 upon 50, 1.80, right, and it is less than 2, so it fails, because you have to have the interest coverage ratio higher. But when we go for 7% and we divide 90 upon 35, what we have is the 2.57, right. So 2.57 is greater than 2, so this will pass, right, which means that when the rate of interest is lower, you can see that it improves the threshold and improves the credit worthiness, right. So this is what it implies. It implies in two ways, that here in macroeconomics, when we study, those who are doing economics, you may not be able to get the examples, but these examples I have tried to connect with some people. And what happens that here we are not just measuring the interest expense, when the rate of interest is low, how it leads to the credit worthiness of the firm. So this is what it implies here, right, greater than 2, and this is what it shows here, right. Now if we just try to get into, so this is what here we have. Interest rate coverage, so EBIT upon interest expense that the firm has, this is what it has to be greater than 2%. So at least 2% rate of interest firm must be able to pay, otherwise it will not be good. Then bank rate is interest rate cap, if it is 50 crore, then for example here in this case we are saying that with the rate of interest decrease, the firm is able to meet, otherwise at 10% it is not able to meet. So this is what here we have, and this also act as a constant. So this is what it implies. Now we are seeing that here we have, so this we have done already. So from post cut coverage meets the lender covenant due to lower interest expense, and this is what it implies here, right. So this is what we get. Now if I have to think about the headroom, right. So headroom, we are saying that headroom for the firm is how much? Rupees 15 crore, right. This is what is the headroom. Maximum debt allowed, so maximum debt allowed, so 50 upon 0.07%, so it is coming out to be 714, right. So how much is the debt change? So debt change is around 2143. So because of the lower rate of interest, bank so firm is able to borrow more than 500 crore. So how much it is getting? 214.3 crore. This is what we call it as the liquidity effect in case of monetary policy angle, right. How much it is liquidity effect we see. If incremental borrowing finances investment, so this is what delta I and delta D we get. And if you see that investment, how much we have seen, it is seeing 2143. If we have the multiplier of K into, so your multiplier is 2, so overall you see in your aggregate demand 428 crore. So you can see 10% rate of interest, if it comes down to 7%, we are seeing the increase in the investment by 400 to 8.6 crore. Now you can see that why the central bank becomes crucial, because why the rate of interest change become crucial, because it has the direct impact on the overall multiplier effect or investment outlook of the economy. With this I am stopping it here, and I hope you are enjoying. So let me cover this part, and then so I think we have done already. So which means that interest rate cut, interest savings and higher interest coverage ratio, more debt capacity, investment goes up, and as a result your output goes up, right. So this is what it implies. So I hope with this we will be able to close this session, and then we will be moving to a new topic. And I hope you are enjoying these nuances that we are discussing with monetary policy at a very micro level and trying to connect with the macro. I will be also adding some more dimensions to cash flow in the later session. Thank you so much. I really appreciate it.